Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's going to be wealth building, commodities, and or financial topics that I'm going to cover. And we're going to dive right in, and I'm going to sprinkle in my financial opinion as we go through this and as I read people's opinions and charts. Uh, so let's go. If you want to follow me, it's at funny_finance. And if you want to join our community where we talk individual sectors and individual companies, finding-value.com is where you want to join. So Gary says, in our modern managed markets, it takes more than technicals or fundamentals to develop successful trading strategies. You also need to anticipate market manipulation. I tried to get people to buy gold in October when it was showing signs of selling exhaustion. I was told I was crazy. Gold was going much lower. I warned traders there would be a huge attack by the banking cartel to try and stop the rally at $2,000, but that it would ultimately fail. I tried to warn traders with my tweet on December 2nd that there would be another attack on gold to stop the rally at the all-time highs. I warned subscribers to get off leverage and go to the least half positions in preparation for that attack. Of course, I got lots of comments that I was wrong at every turn. In our modern managed markets, you also have to be aware of when and where market manipulation is likely to happen. The Fed is done hiking interest rates. That means they have to try and keep gold suppressed either by job owning or by blatant attacks on the metals market. We got the blatant strategy in the middle of the night on December 4th. We will get job owning on Wednesday when they will talk tough, but fail to follow through. In the meantime, I also expected the stock market would be propped up on the FOMC meeting, so it's in a better position to weather the letdown of a more empty hiking rhetoric. But since stocks are already rallying hard in anticipation of no rate increase, the odds favor a sell the news reaction to Wednesday's interest rate announcement. It will just be a temporary profit-taking event, though. Stocks are headed for a test of the all-time highs by the end of January. What are your guys' opinions on Gary's opinions here? Do you think the gold market is manipulated? Do you think they're trying to hold it down at the $2,000 level? It does seem weird that gold generally trades higher in the Asia markets in the pre-market, kind of at night. And then somewhere in the morning, it always gets slammed almost religiously. It is very weird. And I'm in the camp where I think they're trying to hold it down, but I think they will fail. I don't think they're going to be successful. I think they can hold it down for a short period of time, but they're going to get overwhelmed, and people are going to run to the metals with so much money, it's not going to matter. That's kind of where my thoughts are. It says, by the time Alibaba went public in 2014, the company reported 10 billion in trailing revenues. If you invested 10,000 in the IPO, today the revenue figure would have swelled to 125 billion. Yet your investment would be worth less than $8,000. There is a huge disconnect with a lot of companies right now. Because I think Alibaba is about as big as Amazon in terms of revenue, if I think. And the market cap is just a fraction. I know the growth rates are the same, roughly speaking, of Alibaba and Amazon. Amazon's been ripping. Alibaba's been, it's way down in comparison. But I don't know. I think Baba's a pretty good company to look at. Look at the revenue. It's going sideways. I know we've gotten a slowdown over in China, but usually tech companies do really well at the beginning phase of a recovery phase in real estate, which they're in. And if the dollar were to drop, I think some of these tech companies overseas in emerging markets, I think they're going to do very well. I really do. Someone said, I often watch Gareth Soloway's pre-market show on Gold Weekly. He painted this chart of the nature of cycles. They become smaller as we are approaching a pivot point, and he or she says, love it. Well, the reason is because the selling pressure isn't as great as you basically keep hitting that resistance line. So you're basically slowly wearing out the sellers. The sellers are the greatest when you first hit it. It comes back. They hit it again. Selling pressure pushed it down. Then you hit it again, and then there's less selling pressure. It means it's going to break to the upside. That's what it means. It means that the sellers are being overwhelmed by buyers. And eventually there'll be a lot less sellers as they get overwhelmed by the buyers at that price. David Rosenberg says, the net long position on the NASDAQ 100 by asset managers and leveraged funds is at record high. When a trade becomes this crowded, how long until things reverse course? I agree. Look at the high there, guys. They are all piled into the all-in on tech and the AI trade. Usually when people are they're all on one side, it usually reverses. So maybe we see a reversal in the NASDAQ and S&P 500. That's kind of my thoughts. A major flaw in the new bull market narrative since last year is the narrowness of the tape, with only a handful of mega growers pushing the indices higher. However, there are signs of improvement since the retest low of October 27. With 83% of stocks trading above their 50-day moving average, the tape is broadening. So usually when it narrows, you get a slowdown in the market because you lose market breadth. But if it's starting to widen or broaden, that is information that we could go higher. Now, here's the thing. We've got all this conflicting information, all these conflicting opinions, and of varying people. Some people think we're going to all-time highs. Some people think, like Felix Zulauf, thinks we're going up and going to turn over and head back lower. Some people are calling for recession first, second, third quarter of 2024. Others think that, we're not going to go into recession. It'll just be a small slowdown. The opinions are all over the place. If I were to try to make investment decisions based off of the opinions of people and the data that they share, I would be one confused person. There's only a few things that you can do in the market, in my opinion. And the easiest thing to do is to identify where there's valuation gaps. And then you just ask yourself the question, this valuation gap exists. And let's say it's a very big valuation gap in a stock or a commodity or an equity or something. Then you just say, well, how long do I have to wait for this to really revalue itself? What market conditions in history do they revalue itself under? And if the market conditions are within a few years, then I would say go long and just stay with it and use time as your buffer. I don't know of any other way to really make good amounts of money in the market outside of knowing what the given is, which is your valuation. You can't control the market in the short term. People try to time it using technical analysis, but technical analysis on the short term, I think, is getting incredibly difficult to do because the patterns, I think, are being broken by like high frequency trading sometimes. I am seeing a unsurmountable amount of false breakouts occur almost all the time. It's like they force it lower and then get everyone to sell, and then they buy all those shares and then rip it to the other side, the slingshot pattern. So I think you have to have value on your side. You have to buffer yourself with time. And then the technicals in the short term, I think, are becoming less and less meaningful as programs and robots try to take over the trading. So they're going to play with your emotions in the short term. And most people, I mean, you're basically just going to give them money in the short term. If you try to play the short term game, that's my take. Oh, this is interesting. We've got Saudi crude exports that are very low in the month of December here. So they are cutting back for crude exports, just an FYI. Art Berman says, meeting the peak demand for delusional nonsense. It says, new solutions coupled with efficiency force out demand for fossil fuels. And it's just nonsense, guys. I hate to say it, but solar and wind is not going to take up that amount at all. The only thing that could probably do this would be nuclear. I have no doubt in my mind that solar and wind, they have no chance of making that type of impact to cover the energy needs that they're showing here. The only way that I see this going forward is I think fossil fuels is gonna roll over here, and I think the price of fossil fuels is going to go ballistic. I think solar and wind are going to be priced out of the market, and everyone's going to FOMO into nuclear. I mean, FOMO into nuclear. It's going to be big. So the value is in the fossil fuels because that's where there's large amounts of energy return on investment. If that goes short, there's not really going to be a good plan in the short term to buffer that outside of burning more fossil fuels. So I think the short term fossil fuels is going to go way up. And then I think people are going to wake up and say, crap, we need nuclear. And then nuclear is going to be a massive growth industry. When are people going to come to that realization? I don't know. But my take is when fossil fuels squeeze and when it meets the debt of all these different countries because they're going to be doing inflationary measures, it's going to put fossil fuels in a massive shortage. And that's where your inflation is going to come from. And then everybody's going to run over to nuclear and try to implement it as fast as they can. That's my guess. There's my prediction, guys. Boom, U.S. House Bill HR 1042 to ban the import of enriched uranium from Russia has passed. Holy crap, what are they doing? So this could be quite interesting. It's going to be quite interesting with the banning of this. So we'll see what happens, guys. I would guess. Remember, people might sell this news and then we might get a small pullback and then we rip. Or maybe we just rip. I don't know. Difficult to tell. I ride through all this news crap. Doesn't really matter to me, but I don't know. That's pretty big news. We got default rates on credit card loans from small lenders has spiked to 7.5%. This level is higher than the dot-com bubble, the financial crisis, and COVID-19. This is not looking good. Well, yeah, it doesn't look good for the default rate for credit card loans. Oil sentiment continues to erode, approaching historically low levels, corroborating what subjectively feels like overwhelming negativity at the moment. This too shall pass. So this is net oil length, non-commercial. It is way down there in net length. Look at that. We're basically below all the other areas. It makes me want to buy a bunch. Usually I just take the opposite side of everyone else. And it generally works quite well. In 2020, if you took the opposite side, that would have worked incredibly well. Bottom of 2022 here. Another one showing up, soon here. 2016 was a really good area to buy a lot of the commodities with. So, yeah, you basically just do opposite of this net length. And you can notice we've got a downtrend going here. And we're basically doing a retest of that downtrend. If I were to save this image, I'll copy the image. I'll just show you what I'm talking about so you guys see it. So there's the image, and I'm just saying that this guy there is like basically doing a retest here. So we're coming back and almost doing a retest right there. And we also have, if you look over here, crap, this one you have to hold this one down. It's a falling wedge. See that, guys? It's a falling wedge on net oil length and non-commercial. I mean, this is your, if I were to draw on here, number one, number two, number three. You come to the corner, you break out, you do a retest, and we're right at the retest location. This is where we could see a big move to the upside. Like this is the big downtrend end since 2018. So this is crazy, guys. I love this. It's making me even more bullish the more I look at a lot of these charts. I think length's going to come back into the markets. We'll probably bottom here, and I bet you we move on up at some point. I'd say relatively soon. It says how not to lose money in the stock market. He says wait longer. Just wait longer. As time horizons grow, equity losses fall off. Probability of negative returns based on S&P 500 total returns from 1929 to present. One day you have a 46% chance of not losing money. So this is negative return. So you have a 46% chance of the probability of a negative return in a one-day holding. 38 in 1 month, 32 in 1 quarter, 25 in 1 year, and it's only a 6% chance in a 10-year time frame. That is what I mean by hedging yourself with time. You need to wait longer. 1 day, 1 month, 1 quarter is not enough time. You need to think in decades. And that's how you really sift out all of this, the narrative, or not the narrative. It's basically sifting out the value that you identified in the market. It takes that amount of time to really extract that value out of it. And everyone wants to make money as fast as possible. I get it. You want something for nothing. But guess what? Your probability of success declines rapidly when you take shorter time frames. It is very difficult to make money on a short time frame. So what I have learned when I invest all these years, the 20 years that I've been investing for, is I need a longer time frame. I need to hold longer, and I need to identify where the value is in the market. And you need to combine all of that together for a strategy. The thesis is generally what occurs in the business cycle and has occurred in history is if you identify where we're at in the cycle, expansionary phase of real estate, we want to identify where the value is in the market. Commodities are cheap to stocks, and they are improving. They've broken down trends. We have an increasing interest rate environment, et cetera, et cetera. If the value's in commodities, we need to buy the value, buy stuff that's down, buy it in a base, buy it in a falling wedge, et cetera, et cetera. And then you hold on for a longer time frame, so your probability of success goes up. In the short term, though, you are going to have massive volatility because commodities are more volatile than tech stocks and regular companies. The reason they're more volatile is because they don't control the selling price of the commodity. It is freely traded. But that is also one of the reasons you want to own it, is because if there's a shortage or there's a gap between credit expansion and supply, which there's going to be a massive gap in the future, in my opinion, that is where you get the margin expansion. That is where 30 years of returns can happen in 5 years. That is how you get these gigantic mismatches. But you have to be able to control your emotions and your psychology, buying at these ridiculously cheap prices and being able to ride the volatility and be patient enough for it to work. That is the special ingredient That's the special sauce. And guess what? It's really not that special. All you have to do is get in cheap, be greedy when everything is down, be relentless. Just be like, you know what? I know this is going to come back around like it has every single time in history. And then sit on your hands and just don't do anything. And the majority of people really struggle with that. They struggle for the waiting period. They think it's too long. Well, I hate to say it, but I don't know anyone in the market who has made vast amounts of money playing the very short term. I don't know a single person. I don't know a single person in real life. I don't know a single person that I've read about. The people who played the short term, they would make their money, lose it all, make their money, lose it all, make their money, lose it all, and then die completely broke. His name's Jesse Livermore. That was the best trader that they considered to be the best. And the guy went broke like 3 or 4 times and then committed suicide at the end of his life. And that's what the best trader can do, is go broke 3 or 4 times. And he would just pile on trades. And towards the end of his life, he figured out that the big money was made in holding longer and identifying the big trend. That is what he learned. Not playing the short little market movements. So even the best trader in the world lengthened his time frame to play big trend moves to make the big money. But he would also bet everything. He was like a gambler personality almost. Here's Steve, Millionaire Habits. I wanted to make a comment on this. He said, about 5% of my coworkers were top performers. They crushed it inside and outside of the office. Most were millionaires. And I took notes. I studied what they did. They all had the same 12 characteristics that made them wildly successful people. And I'm not going to go through all of them. I'll just go through what the first one is. Positive, produce, confident, risk-tolerant, patient, self-reliant, creative, ethical, exercise, unafraid, honesty, and priorities. I'm just going to say this, and this is what I wanted to comment on. I was a top performer early in my career. HR brought me in and management brought me in and they told me that I was a high performer. So they called me a hypo. And they identified me as a high performer. They got me on like these plans or whatever. And I was doing everything. And like I wouldn't get huge raises and they wouldn't promote me that fast. So I was like, guys, what's the deal here? And they're like, oh yeah, you're a high performer, you're a high performer. And it's like, well, if I am, pay me. Like, what the heck's the deal here? And the money just never came. So I was like, all right, just take me off this. I'm tired of doing the extra work. I'm tired of working all this time. And the only thing I'll say is if you want to be a high performer, go to a company. If you want to work a 9 to 5 or whatever, go to a company that's going to pay you for your performance. You don't be in my opinion, I can't be a top performer if I don't get paid like I'm a top performer. What that is basically telling you is that they're taking advantage of me. Now, rather than going somewhere else and being a high performer somewhere else, I diverted some of my efforts towards other things that I wanted to perform well in. Much of it is due to investing. So rather than trying to convince others to pay me more in an HR department or a manager that really doesn't care, they're just an employee at a large corporation, I took matters into my own hands and started investing massively. I was investing massively from the beginning, but I knew that something like this could happen. So I took it into my own hands and I said, you know what? I'm just going to start investing and I'm going to learn this as best I can. There were times throughout history that I was really, studying it, and there were other times I wasn't studying it as much. But that really occurred. I was doing it in my 20s. I laid off in my mid to late 20s and early 30s because I had kids, got married, etc., etc. There's a lot of stuff going on. And then I took it up back up again in my mid to late 30s. And that's where I focused my efforts. If your efforts are focused on something, you have to be careful because, I would go home and I would think about work and how to solve problems, and I was not getting paid for that. I probably thought about work a lot more than what I was getting paid for. When you're trying to think of a solution in your sleep and it's basically, it's running through your mind, they don't pay you for that. And what occurred when I started the YouTube channel in 2020, I was thinking more about videos, what content do I want to come up with, the video and the charts that I wanted to do. I literally was working for a company, and my entire thought process was consumed with other things in terms of investments, in terms of other things that when I was working there. So they literally turned me so far around where I was from, trying to figure out solutions for their problems at home to me thinking about how I can run stuff outside of the company when I was working at the company. That's how far I turned. And that is where it was a learned trait over the years. It was a high performance turning to just a workhorse, turning into a dog over all those years based off of the merit increases and the my promotions that I received or didn't receive over the years. Cape's not throwing in the towel. He's talking about the Capesize, the rates for dry bulk shipping. Cape's not throwing in the towel as many expected, trading back over 34,000. This is great if you're an investor and you've got big dividend paying stocks, because when these stay up here and they just stay up and elevated, you're making more money. You're going to get bigger and bigger dividend yields. So keep this thing on up. Logan says 3.2% away from all-time highs in home ownership rates. And hopefully this continues to go all the way to the top. That is where the demand for homes is coming from. You can see the big move from 1965 all the way onward to 1980 in terms of home ownership rate. That was the big inflationary surge. We also had an inflationary surge from the 1998-ish all the way up. This is your credit expansion in the system comes from an increasing demographic with an increasing home ownership rate. We can see that we bottomed in 2016 and we went into an expansionary phase here. I would say when home ownership rates went up above 65%-ish. We are still at 66%, and I think we're going to go higher. With a larger demographic, as your percentage goes sideways, you have more and more buyers. Keep that in mind as well. Patrick says, depending on where this chart goes next, single-family homes might get cheaper in real terms. Now, look at this chart in terms of home ownership rate. Let's just look at it real quick. 65 to 1980, 1995, there was a big increase all the way to 2005. Let's look at this over here. This is houses priced in gold. 1970s going up, and this is houses getting cheaper against gold. Then we had houses get more expensive, but that was really gold relaxing. 2005 all the way up to 2011, remember, that's stimulus money and gold offset behind it. And I think this is actually houses going to get cheaper in relationship to gold, because the market conditions that occur in an expansionary phase of real estate and the credit expansion that occurs, there it is. House, I think we're going to go up, is because gold accounts for the money supply during that type of environment. So gold is going to get priced more. It's going to increase its purchasing power against other things, like houses. So house prices will go up, but gold's going to go up faster. That is my guess. So if you want to buy a house, I would invest in something like platinum and silver, because I think it's going to go up faster than gold. And I think gold's going to go up faster than the house prices. But remember, when you buy a house, that's a leveraged bet. Usually people buy that with a loan, with a mortgage, and you are leveraged to the price of that house. So you put less money down, borrow more money, and the price of the entire house goes up, irrespective if there's a loan against it or not. Gary says, in the chart below, you see the first two 8-year cycles produced the first leg of massive multi-year bull market. The third 8-year cycle has been a consolidation phase to digest the gains of the massive first leg. The fourth 8-year cycle is just beginning. This will be the 8-year cycle where gold breaks out and ultimately produces the second and final leg of the secular bull. This 8-year cycle is where gold and silver will give us the bubble phase. I can assure you the banking cartel will not be able to stop this, and any efforts to do so will ultimately just make the bubble phase that much bigger in the end. Seriously, when the government interference in anything produced the desired result, the only thing government is going to do is F it all up. So we've got the 8-year cycle low in 2008-9. We have another 8-year cycle low in 2016, and we have another 8-year cycle low that occurred late in 2022. And we're going to go into a big bull market in gold. You guys ready for this thing? I am. I'm ready for it. Let's rip this thing. We've got a warning. The yield curve is steepening rapidly from inverted levels. This brings the economy even closer to an economic downturn. This won't end well. Now, here's the thing about this, when these people trying to make these predictions. The curve inverts and it's starting to come back up, but do we get something where it comes back down like 1980? Do we get it where it comes back up and comes back down like the 1970s? I don't know if you can use this as a predictive measure that we are 100% going to go into a recession soon. It just means that when this does uninvert, whenever that does occur, that is when the recession occurs. This doesn't predict recessions. This is just where we're at in the cycle. We are at an expansionary phase which inverts the yield curve. Now, I'm not saying that it can't uninvert and that we can't get a slowdown in the next month. That is not what I'm saying. I'm just saying is the curve is a lagging indicator of where we're at in the cycle. And where we're at in the cycle is an expansion phase of real estate. Now, has that expansion phase of real estate stopped? It hasn't. We haven't gone into a hyper supply phase, but that doesn't mean we can't get a slowdown in the market. And that is where it becomes incredibly difficult to try to project when a recession will 100% occur. We could stay inverted for years. We may uninvert next month. I mean, that's the tough part behind trying to make these predictions that some people are trying to make. I thought this was interesting. The United States Air Force is offering $600,000 in bonus to retain pilots. Is this for a war? Like, what's going on here? I just thought that was interesting. Like they're almost advertising that something is about to occur. 2024 can be the best year of your financial life. All it takes is setting the right goals. He's got 7 financial goals you should set to double your net worth in 2024. Double your savings. Make an extra payment if you've got any sort of debt. Use cash for purchases. It'll slow down your spending, hopefully. Ditch the credit cards. Adjust your time horizon. Most people want to get rich in 2024. Aim to get rich in 2034. Take the long-term approach. Buy the value in the market and be patient. Reduce purchasing budget by 15%. It says these won't double your net worth right away the first time you hit the goals. These are habits you build. If you maintain them for years to come, you'll more than double your net worth. So I am a guy that's really, I don't spend a lot of money, guys. And I'm going to end it probably there. I don't spend a lot of money, guys. I really don't. And I don't find happiness in it. I find happiness in saving. I find happiness in independence and freedom. That's where it is. And I have all my basic needs met. I bought my dream car. I like cars a lot. My dream car is an RX-7. I drove one back in, man, 2000, was it 2001 or two? My roommate bought it when I was in college. He bought it for cheap too. He bought it for like 8 grand. And he didn't know how to drive a manual, so I drove it back from where they delivered it, which was in Fresno, and drove it all the way back to San Luis Obispo. And I drove that car, and I was like, man, this thing is awesome. It is freaking awesome. Like, I drove a lot of different cars, but that car's light. It just moves back and forth like it's nothing. It had good power. It had, it's got the turbo. That one had the stock turbo on it. Mine's got a single turbo on it. But I just drove that thing. I was like, man, I have to buy one of these at some point in my life. And I did when I was 30 years old because I wanted to save before it. And then I saw the RX-8 and I was like, man, this thing is cheap. I wanted a normally aspirated rotary because I thought those were fun too. So I already have kind of what I like and what I want. The thing that I struggle is, what can I do in my life to make it that much better? What can I buy, or what experience can I have that would make my life that much better? And guys, if you've got ideas or opinions, put it in the comment section. Love to hear your opinions on what I could do to make my life that much better. The top thing that I did is I bought a really nice bed. That's pretty sweet, but it didn't cost that much money. It was like $400 or $500 or whatever it was. I bought it like a couple years ago. Maybe it was like 4 years ago. That was a pretty big difference. I bought a really nice pillow too, because you do sleep, and having a nice pillow and a nice bed, that works out pretty well. And most everything else, I already work out. I already do everything health wise and try to eat pretty good. Not much else that's really out there. So anyway, that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Let me guys know if you guys are interested in me opening up another YouTube channel, like fixing things or whatnot, because I find it incredibly satisfying taking something that somebody sells for a really cheap price and then fixing it into something that is usable again. And some of these things, like, the value is so good. The RX-8 I bought with the bad engine for super cheap. I dropped a new engine in it, and I love that thing to death, man. It's so fun to drive. It is so fun. But if you guys are interested, I can create a channel that can help you fix things. Brake jobs, stuff on cars, stuff on toilets, stuff on, I don't know, if something breaks on a garbage disposal, whatever it is, I could tape it. I'm going to be fixing it anyway. So I could tape it and share it. And if you guys want something like that, I can do that. But put in the comment section if you guys are interested in that. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.